diversification, reduce exposure to tertiary locations, and remove weaker or tired concepts. The median disposition cap rate across all these sales, which were not our best assets by any means, was 6.88%, which is below our currently implied valuation. This quarter, we sold 5 tertiary Dollar Trees, a Friendly's in New York, a Staples in Illinois, a Fast Pace in Indiana, and a Hooters in Kentucky at a weighted average 7.12% cash cap rate. Each transaction improved the overall real estate quality, tenant credit, or diversification of the portfolio. Continual portfolio optimization is part of our business model, and we will continue to proactively prune the portfolio as part of our ongoing value creation strategy. While the bulk of our portfolio optimization is complete, we will remain active in recycling capital where we see opportunities to enhance portfolio quality. The result is a portfolio with strong operators, exceptional real estate, and one of the most diversified tenant bases in the net lease sector. Importantly, investors can evaluate the portfolio directly, as we are the only net lease REIT that discloses 100% of its ABR by tenant and the address of each and every property. Turning to acquisitions, we acquired 17 properties for $58.2 million at an average cash cap rate of 7.34% and a weighted average lease term of 7.3 years for the quarter. These acquisitions were consistent with the real estate characteristics we target across the portfolio, with median metrics including a purchase price of $2.6 million, building size of 5,700 square feet, Placer AI score of 20.4, annual rent of $217,000 per property, and 5-mile population of 141,000. We continue to target larger MSAs with an emphasis on established, well-populated growth markets. While cap rates in these markets have historically been somewhat lower than the US average, we believe the premium is justified by strong demographics, favorable supply and demand dynamics, and greater long-term rental growth prospects. The weighted average lease term this quarter was slightly below our historical average because we purposefully acquired several properties with shorter remaining lease terms. These assets have below-market rents, strong tenant performance, and clear opportunities to create value through lease renewals or extensions. Our market knowledge and relationships allowed us to acquire them at prices well below their longer-term intrinsic value. We view these select transactions as a form of risk-mitigated development. They can provide development-like spreads without requiring us to assume construction, lease-up, or entitlement risk because the tenants are already open, operating, and paying rent. As an example, we acquired a veterinarian clinic backed by a national guarantor in Indiana with a little more than 2 years left under the lease at an 8.75% cap rate. The cap rate was reflective of the short term remaining, but through our relationship with the tenant, we are extending the term to 12 years without providing any significant concessions, creating a wide development-like spread with zero development or construction risk. After the extension, this alone would have raised our WALT on acquisitions from 7.3 years to 7.7 years. Consistent with prior quarters, we are highlighting one acquisition this quarter, a corporately guaranteed Aspen Dental property in Roseville, Michigan, which is on the cover of our investor presentation. The property is located on a hard corner, out parcel to a Kroger supermarket, with frontage along a major arterial carrying over 25,000 vehicles per day. It also ranks in the top 15 of its concepts statewide based on Placer AI. Roseville is a suburb of the Detroit metropolitan area, the 14th largest MSA in the United States. Founded in 1998, Aspen Dental supports a nationwide network of more than 1,100 branded dental offices and is one of the largest and fastest growing dental service organizations in the country. We acquired the property at a 7.2% cap rate with annual rent of only $147,000. Given the quality of the real estate and low rent, re-tenanting would be a source of upside if it were ever given the opportunity. This combination of credit and use, exceptional real estate location, readily releasable box size, replaceable rent, and potential upside is a prime example of a FrontView target acquisition. The asset was previously under contract with another buyer at a cap rate in the mid-6 range, providing market validation. When that transaction failed to close, the seller prioritized certainty and speed of execution. FrontView stepped in, closed quickly, and acquired the property at a higher cap rate. This transaction demonstrates our ability to create value through sourcing, asset selection, certainty of execution, and the relationships we have developed across a fragmented marketplace where our typical transaction size competes less with institutional capital. This allows us to avoid portfolio transactions where pricing is a premium and invariably contain real estate we would not want to own. Last quarter, we introduced the concept of evaluating select development partnership opportunities that would leverage our team's decades of retail development experience. These partnerships could expand our sourcing channels and allow us to earn higher yields while maintaining our focus on real estate quality and mitigated risk management. We continue to evaluate a number of potential developments that meet our underwriting standards. We remain highly selective and will only pursue opportunities where the incremental yield is accompanied by appropriately mitigated execution risk. We will update you in coming quarters on this initiative. Turning to the portfolio, we ended the quarter with only 2 vacant properties, resulting in occupancy of more than 99%, in line with our historical average of 98 to 99% plus. While we expect occupancy to remain high, we do not manage the portfolio to maximize a headline point-in-time occupancy percentage. Because we own exceptional real estate, a lease expiration or vacancy can create an opportunity to improve tenant credit, increase rent, create a valuable ground lease, or otherwise enhance the underlying property value. Historically, when we have re-tenanted properties, we've achieved rent recaptures north of 110% of prior rent, which reinforces our strategy to create value by being patient and pursuing the right long-term outcome rather than defaulting to a quick sale. That being said, in some situations, a sale of a non-performing asset ends up yielding the best outcome. On page 15 of our investor presentation, we highlight a dark Hobson Drops that we sold just after quarter end for a 5 cap rate or $3.75 million, which was a 50% increase over our original cost basis of approximately $2.5 million. Another example of how our high-quality real estate can yield outsized returns. From a credit standpoint, we are performing very well. We do not have any additions to our watch list quarter over quarter and have a placeholder for 50 basis points of bad debt for 2026 that remains relatively unidentified, other than about 20 basis points attributable to the Sleep Number bankruptcy. For context, we previously owned 4 Sleep Number properties. We converted 1 to a 7 brew. We retained 1 high-performing location through the bankruptcy, sold another shortly after quarter end at a 6.5% cap rate, and are re-tenanting the 4th, which is part of a cash-flowing 2-tenant property. Sleep Number now represents less than 33 basis points of ABR. Regarding renewals, we have only 8 left this year, and we are already north of 115% recapture rate for properties we renewed this year. So we fully expect renewals for the year to be nicely accretive. During the quarter, we successfully re-tenanted 1 vacant former Walgreens to an Amazon, representing a significant increase in value over our basis. As close to the same rent, but with a much stronger credit profile and 0 tenant improvement allowance. As previously mentioned, we only have 2 vacant properties, including the former Smoky Bones, which we expect to lease to 2 tenants, and a small convenience store. FrontView's platform and strategy positions us for sector-leading growth, with size being a structural advantage. First, we can generate meaningful external growth as just $120 million of net investment increases our asset base by over 13%. Second, we can continue to focus on only adding excellent real estate at attractive values for years to come. Third, we can scale the platform through effective use of AI and new technology tools. And finally, our exposure to markets with rising rents, as demonstrated by our re-tenanting results, creates meaningful mark-to-market opportunities embedded within the existing portfolio. In closing, we are passionate about our company, our people, our alignment with our shareholders, and our ability to outperform. Our focus remains on driving top quartile per share cash flow growth through our differentiated net lease strategy. Every decision we make is made through the lens of owning 100% of the company. With that, I'll turn the call over to Pierre to review the quarterly numbers and guidance. Pierre?
Thanks, Steve. We delivered another strong quarter, driven by growth in recurring cash rents for both accretive capital deployment and organic portfolio activity, together with improved NOI margins. These results, combined with our improved cost of capital and lower levered balance sheet, give us increased confidence in raising our outlook for the remainder of the year. Turning to the income statement. Second quarter base rent increased $200,000 sequentially to $16 million, driven by $59.5 million of net investment completed during the first half of the year, contractual rent increases across the portfolio, and the commencement of rent from the former Walgreens property we released to Amazon. This growth was partially offset by the 3 properties discussed last quarter, which previously generated $181,000 of quarterly rent. Those leases have expired and the properties have been re-tenanted. However, most of that replacement rent will not commence until 2027. In addition to base rent, we generated $200,000 of other operating income related to a lease restructuring. As we discussed last quarter, other operating income is episodic and generally not included in our forecast. However, it is a natural result of actively managing a diversified real estate portfolio and may arise from time to time. In total, adjusted cash revenue increased to $16.4 million. Our non-reimbursable property costs or slippage declined by $32,000 sequentially to $231,000, or only 1.4% of adjusted cash revenue. The improvement was driven by the Amazon rent commencement, a decrease in tenant credit issues, and continued benefit from the portfolio optimization work completed to date. For the remainder of the year, we now expect property level slippage to approximate 2% of adjusted cash revenue, an improvement of 75 basis points from our prior forecast. Adjusted cash NOI, including the full impact of acquisitions and dispositions completed through quarter end, was $16.9 million. After excluding other income and normalizing property level slippage, the portfolio enters the third quarter at an approximate $16.6 million quarterly cash NOI run rate. Importantly, that run rate does not include the future lease benefits once the re-tenanted properties come online. Once fully operating, the new leases will generate close to $225,000 of quarterly rent, representing a 23% increase over the prior leases at those properties. Recurring cash G&A was $2.5 million, consistent with prior quarter, and we continue to expect a similar level of cash G&A for the remainder of the year. Our investment in automation, AI workflows, and data analytics are allowing us to scale more efficiently, improve tenant monitoring, and enhance capital allocation decisions while maintaining discipline on overhead. Turning to the balance sheet, cash interest remained stable at $3.8 million, with our revolver benefiting from the $100 million of hedges we put in place last September. During the quarter, we accessed the equity market through our ATM program for the first time, issuing approximately 2.6 million shares at a gross price of $19.50 per share and raising $50.5 million of gross proceeds. We settled close to 900,000 shares during the quarter, generating $17.3 million in net proceeds. At quarter end, approximately 1.7 million forward shares remained unsettled, representing an additional $32.2 million of future net equity proceeds. This transaction marks an important step in the continued evolution of our company. It allows us to fund accretive investments with new common equity while preserving the remaining $50 million of capacity under our Series A convertible preferred. Together, our available liquidity, unsettled forward equity, and remaining preferred capacity fully fund our current investment plan through 2027 at our existing net investment pace. We ended the quarter with more than $200 million of liquidity. Our loan to value was 33%, and net debt to annualized adjusted EBITDA RE was 5.4 times. Including the impact of the unsettled equity, our adjusted net debt to adjusted annualized EBITDA RE is only 4 times. In addition to our lower levered balance sheet and ample liquidity, our AFFO payout ratio was less than 65%, providing incremental retained cash flow to support future growth. Before turning to guidance, I want to briefly discuss our cost of capital and how we think about growth. Our cost of capital has improved meaningfully over the past year. Based on our current acquisition yields and long-term weighted average cost of capital, we are currently generating investment spreads north of 100 basis points. As highlighted on page 22 of our investor presentation, that spread drives an attractive growth profile. Our smaller asset base means that disciplined investments can have a meaningful impact on AFFO per share growth. However, improved access to capital does not change our underwriting approach, and acquisition volume itself is not our objective. Our goal is to generate sector-leading AFFO per share growth by investing in properties that meet the criteria we have consistently outlined: strong retail locations, larger markets, diversified tenant exposure, fungible real estate, and rents that are replaceable or below market. This portfolio construction gives us two complementary avenues for growth. The first is accretive external investment, or what is sometimes referred to as a net lease virtuous cycle. The second is internal cash flow growth generated through contractual rent increases, re-leasing activity, lower property level slippage, mark-to-market opportunity embedded in the portfolio, and acquisitions made from retained cash flow. This combination matters because external investment alone does not guarantee durable per share growth. If the underlying real estate is weak or rents are not replaceable, tenant credit events and lease expirations can create cash flow erosion and force assets to be sold below their original basis or released at meaningfully lower rates. Our focus is to address these risks at the time of acquisition and through portfolio optimization. The objective is not simply to add cash flow, but to protect and compound cash flow per share over the long term. Turning to guidance. With half the year behind us and the continued outperformance in the portfolio operations and capital deployment, we are increasing our 2026 AFFO per share guidance range to $1.32 to $1.34, from $1.29 to $1.33. We are also raising our net investment guidance to $120 million, implying $60 million in the back half of 2026. At the midpoint, this represents approximately 7% year-over-year growth and marks the third increase in our guidance since it was first introduced last November. The increase is driven by three primary factors. First, strong portfolio performance. Second, accretive capital deployment. And finally, continued discipline on overhead expenses. We entered the back half of the year with a low levered balance sheet, visible embedded rent growth, a high quality frontage focused real estate portfolio, and sufficient capital to execute our current investment plan. Our focus remains on translating those advantages into continued AFFO per share growth while maintaining the underwriting discipline and real estate quality that define FrontView. With that, I'll turn the call over to the operator to open it up for Q&A. Operator?
We will now begin the question and answer session. Please limit yourself to one question and one follow-up. If you would like to ask a question, please press *1 to raise your hand. To withdraw your question, press *1 again. We ask that you pick up your handset when asking a question to allow for optimum sound quality. If you are muted locally, please remember to unmute your device. Please stand by while we compile the Q&A roster. Your first question comes from the line of John Kilichowski with Wells Fargo. Your line is open. Please go ahead.
Hi, good morning. My first one is just on now with this, new access to equity here. I'm curious how you all are thinking about managing the investment guidance number. We put up 120, so a nice raise, but clearly you have the capacity to go well beyond that. So I'm interested in thinking about how you're going to manage, 26 and 27 acquisition numbers, assuming that you continue to have this access to equity.
Sure. Thanks, John. So I think I said in our remarks that the acquisition volume isn't the goal. If we find good deals, we will pursue them. Having access to capital means there's more that we can look at. If you just remove the dispositions and you just do acquisitions, we're tracking close to 180 million if you just annualize the first half. So we can continue to just do that if we just reduce a little bit of the dispositions. I think there's room and capacity to expand it. And obviously the capital that we raised, there was 1950 for the first 50 million, and we also have the preferred equity that's at 17. So we still have to go through that. So I think we want to target cap rates that are very reasonable, and we want to get through that capital. But certainly with the new access to capital, we can pursue more deals. And I think that's part of the plan going forward in the back half of the year and going into next year.
Mm-hmm. Thank you. And then, Peter, one more for you, just on your opening remarks. You gave some helpful color on some, re-tenanting. Would you mind walking through as much as you can just to clarify the rent expected from some of those re-tenantings and timing? And are there any other upcoming known move-outs that you expect may impact 27 numbers or 26 numbers and be a step up into 27 that we should be modeling?
So thanks. So the three were the $181,000 that happened in the first quarter. For 3 tenants. We do expect some of that to come in line in the fourth quarter, but most of it will be in the first and second quarter of next year, going up to 225,000. The other one, obviously, the Walgreens turning into Amazon was a nice pickup, a lot sooner than we thought. And then we have a former Smoky Bones that's vacant. That one we're working through a new lease, and that could be a nice pickup as well if we're able to execute that for 2027. But that's all outside of the current in place NOI, but more NOI that we would expect to pick up next year.
Your next question comes from the line of Anthony Polone with JP Morgan. Your line is open. Please go ahead.
Great, thank you. My first one is maybe a bit of a follow-on to one of John's questions. Now that your access to capital's improved quite a bit, what do you think the platform's, acquisition capabilities are? Like, is $150 million a year, which is kind of where you've been running over the last year, sort of the right level, or do you feel like you have the capacity and you're seeing enough that with greater capital access, you can do more?
Yeah, no, thank you. Good question. As Pierre had mentioned too, as we see opportunities, we certainly can do more. The marketplace is open for us, and I'll remind you that back in Q4 of 24, our first year as a public company, we actually acquired about $100 million of assets during that one quarter, and we have the same team in place today. We do have, for the upcoming quarter, we've got very good visibility on what that's looking like. So far, we've closed on 3 assets for about $8.4 million at about a 7.49 cap rate. And then we have 17 assets that are currently under contract right now at about a 7.4 cap rate for $55 million. And then we're beginning to build Q4 with good deal flow. So yeah, we're excited about the quarters and the acquisitions coming forward.
Okay, thanks. And then just one follow-up. You mentioned 50 basis points of bad debts that you continue to use in the guide, with 20 of it around Sleep Number. But is that 20 like you're using it, or is that just there? Because it sounds like you're doing pretty well in terms of addressing that situation.
Yeah, we're not really using it. Like it's sort of, it was like not in the numbers, and so there's another 50 basis points of just like completely unidentified bad debt additionally that we just keep, but we're not using it.
Your next question comes from the line of Rob Simon with Compass Point. Your line is open. Please go ahead.
Hey guys, how's it going? Thanks a lot for taking the question. This one, by the way, really comprehensive prepared remarks. I have kind of just a clarification question. It actually might have been implied by what you guys said, but on the preferred, is it safe to assume that you guys will likely draw that down, the balance of that down first prior to settling the remaining forward equity commitment? And I say that because, like, if you just think about your net investment guidance and you kind of assume no capital, no equity, common equity capital issued from here, the uses and sources implies about $50 million on our numbers of need by the end of the year. So is it just kind of safe to say that you'll use the preferred first, since you lose access to it if you don't draw it?
Yeah, thanks, Rob. Yeah, that's probably right. Like, we have to draw the rest of the preferred by the 1 year anniversary. So I think like November 10th or 11th. And so I would anticipate we use that first, we save the forward equity, and then we use the forward equity effectively in 27. Like the 50 million gives us more than capacity to get through this year and some into next year. I mean, and mind you, like, we're at 4 times levered if you take into account all that equity. So we have plenty of runway. But yeah, like, we'll use the preferred first.
Yep. Okay, great. Thanks a lot. Appreciate it, guys.
Your next question comes from the line of Jana Gallen with Bank of America. Your line is open. Please go ahead.
Thank you. Good morning and congrats on the quarter. I just wanted to ask a accounting question on the preferred. Is there anything in the AFFO guide, similar to how on the forward you'd have to deal with the treasury stock method dilution? Right now, is there anything in the guide for that preferred?
Hey, Jana, thank you. I appreciate the question. So as we've seen, like, the forward equity has been an issue for some of our peers. So this is governed under like ASC 260 in terms of what the rules are for how that's handled, and it's handled on an if converted basis. So it doesn't have the treasury stock method the way that normal forward equity would be accounted for. So it's going to be treated by what it is. If it's a preferred, we're gonna run it through our income statement as a preferred dividend, and not have the conversion into equity. But there's no, in the if converted method, there's no treasury stock method impact regarding that. So that's not in the guide. Right now, the guide is assuming that the preferred stays as a preferred, and if any of it does convert into common, the net impact's actually not that meaningful, because we would have the 675 preferred dividend would go away. So it's close to the same amount anyway.
Thank you, Pierre. And then again, thank you for the excellent disclosures. I just wanted to make sure I understood that in the tenant list in the SUP on pages 14 to 17, the asterisk for the new leases, those are the ones that those are the re-tenanted assets that you expect to be coming online a little bit in the 4Q and then primarily through first quarter 27?
That's right. So those are not in our AVR, but those will be in our AVR once they're operating and open. But as I mentioned, the leases are signed, but they're not paying rent until they're operating. So there's a little time, but those are the ones that we highlighted in asterisks in the SUP.
Great, thank you.
Your next question comes from the line of Ronald Camden with Morgan Stanley. Your line is open. Please go ahead.
Hey, great. And again, thanks so much for the disclosure. Just coming back to the acquisition pipeline a little bit, sort of thinking about sort of the cap rate in the quarter, I think 7.3. Obviously, you guys are also thinking about IRRs and so forth. I guess part of the strategy was to be able to sort of get these sort of higher cap rate deals. And I'm just wondering, as you're thinking about sort of the current pipeline over the next sort of couple years, like, how do you sort of see these cap rates trending? Do you see compression? Do you see more competition? Any color there would be helpful. Thanks.
Sure. Yeah, no, it's certainly tough to predict, too far out. But, what I can say for us right now is that, the market is stable. We're expecting cap rates in that sort of 7.3, 7.4 range for Q3. We could see, maybe slightly lower, a tick lower in Q4. And really that's a result from increased institutional, just general interest in overall retail and net lease. I mean, there really is, I think, as we all know, an abundance of capital that's just really setting the tone for the marketplace. And so as we see, we've seen, retail and open air and shopping center cap rates come in. We've had a little pressure on cap rates, but certainly not to the same extent. So again, I think, for the foreseeable future, we hopefully will be in this range.
I would just add, Ronald, if you think about the pipeline that Steve talked about, we in the second quarter, our deals were 2.6 million median purchase price. We don't really compete with a lot of people at that purchase price. It takes a lot. If you're doing, 10 billion of acquisitions, it takes a lot of $2.6 million. For us, we can do that. We have 17 deals under contract, 3 that we've already closed. So it's a very robust pipeline, but we're not running up against competitors, and we're still finding deals that ink at cap rates similar to what we've done.
That's right, and we're not competing with the institutions on the big portfolios or the larger assets, which again is an advantage for us. Buying those smaller assets, sub 10 million, we're just not running into the big guys, and that provides us a competitive advantage in the market.
Great, that's really helpful. And then my second one.
Oh, I think we lost Ron. Ron, if you don't mind just coming back in the queue, I think that the operator put you up.
My apologies. Your next question comes from the line of Matthew Erdner with Jones Trading. Your line is open. Please go ahead.
Hey, good morning, guys. Thanks for taking the question. I'd like to talk on dispositions going forward. Are there any credits that you guys are wanting to work out of? I noticed cap rate investment spread came in from, call it 60 basis points in the first quarter to 22 this quarter. Are you going to look to sell some of your higher cap rate properties, or should we expect it to be, a little bit on the lower range, sub 7s going forward?
Yeah, good question. Just to recap, so far since going IPO, we've sold about 15% of the portfolio, about $116 million of assets at a 6.9% cap rate, and we're going to continue with the strategy of portfolio optimization. We're certainly not selling off our best assets and are not planning to do that. We're going to continue with, strategically selling concepts that we think they could come under pressure, maybe less optimal concepts or sort of tertiary real estate that we just want to reduce exposure to. Year to date, we're about 32 million. We feel like most of the optimization is complete, and we expect, dispos to last year they were roughly in the $80 million range, and this year coming into that $50 million range. And the sale of the Dollar Trees was really the reason for the elevated print in cap rates for the quarter.
And I would just add, like quarter to date, like in Q3, we highlighted Hops and Drops that was done 3.8 million under 5 cap. We also sold a Sleep Number in the quarter. I think Steve mentioned that was 4.6 million at a 6.5 cap. And we did sell another Applebee's in Surprise, Arizona for 3.5 million at 6.8. So some of these things we're still doing. We find them. There's a lot of interest for our properties. But it's certainly none of these are distressed sales. People just want locations, and we continue to find opportunities to add diversification and do a few dispositions here and there.
Got it. That's really helpful color there. And then just as a follow up to that, how do you guys kind of go out and market your properties? Like, are you out there marketing them, or some of these reverse inquiry? Just how are they sourced?
Yeah, that's sort of the beauty of the market is we do list them, we blast them, we get them out to as many people as possible. We create a lot of interest, a lot of buzz. We use top brokers and relationships that we have in the space, and we're selling to those buyers that can pay top dollar and premium pricing for it. And a lot of times it may take a time or two to get under contract and close, but we end up with that 1031 or that small unsophisticated buyer that really likes and wants that asset, that good quality location with the good rent. And so it's important to make sure that we get that out into the market and the eyes of as many people as possible.
And I would also add, like even with our website ad having every address, we do actually have random inbounds, even from other REITs that say, "I did not even know you had that property in front of our site," and they come in, and so there are just like a lot of cold reverses that want to think of other to buy.
Awesome. I appreciate it, guys. Thank you.
Your next question comes from the line of Ronald Camden with Morgan Stanley. Your line is open. Please go ahead.
You're back.
Sorry, I got dropped. I had just a second simple question, just on the investment volumes in the quarter, the acquisitions. I think it's been asked for, but is this sort of the right run rate for the team, for the business, for the opportunity set? Obviously assuming you have the cost of capital, like, does this feel like a good run rate to execute on going forward? Thanks.
I think, as I said, that we're continuing to look at opportunity. We have the ability to increase the run rate when we see good acquisitions that we like, and we can continue to have sector-leading growth with our current guide. And so going forward, or at least through the rest of this year, that seems like a good number for the moment.
Yeah, I mean, if you go back, Ron, to page 22, like, we don't need to do a lot to kind of hit our numbers. And if we're growing on acquisitions, call it 3 to 5% on only 100 million around that area, but then we have escalators, we have reinvestment of free cash flow, we have this recapture of leases. You add those components up in terms of the recapture, the free cash flow, the acquisition, the escalators, you're talking about a lot of growth that can happen off of this base. And we're able to do that and continue to find the best deals. And so we continue to look for that. And I think we can obviously expand it by just reducing dispositions or finding more interesting deals. But it does deliver a little bit of outsized growth relative to at least the comps that most investors look at us against.
Right, because our size really is a structural advantage, and with that 120 million of net acquisitions growing off that low base, even popping that up a little bit, you continue to add top quality real estate, great markets, top MSAs, replaceable rents, and we don't have to sacrifice the quality in any shape, way, or form going forward for years and years to come to have outsized growth.
Great. Thanks so much. Thanks for taking the follow-up.
Yep,
You bet.
Your next question comes from the line of John Massocca with Riley Securities. Your line is open. Please go ahead.
Good morning.
Good morning.
Apologies if I missed this earlier. Apologies if I missed this kind of earlier in the call. What was kind of the genesis of the tight kind of cash and GAAP cap rate spread on the TQ26 investment activity?
So it's just escalators. It's just escalators in terms. So if you think about what drives a cash cap rate versus a GAAP cap rate, is what's the escalators and what's the WALT. And so if the WALT was a little bit shorter, and the escalators, there's less of a difference in the current quarter. But I'd point out that a lot of these deals that we signed up are getting extended. And so even though there was a shorter GAAP impact at this point, as those leases get extended, it'll run through normalized rental revenue.
Okay, so it's just the stage in the lease at which you bought a significant number of these assets. It wasn't like the flatter leases or some kind of CPI-based escalators.
Correct. Like if you think about where they are, and if they're second or third option.
Right, well, there could be 5-year leases that you buy them early on, or 5 years remaining, and you already have the bumps. You got to wait 5 years for your next. Because some leases bump annually, and a lot of them bump every 5 years. So a lot of that is just where you sit in the curve on the lease.
Also appreciate I believe it was new additional disclosure on the ground lease portfolio.
Yeah.
Maybe with that in mind, is that still an opportunity for investment volumes? I mean, are you seeing cap rates in that space kind of akin to what it is for your other acquisitions or investments? Or is that kind of maybe at this point more of like a legacy portfolio around how FrontView was kind of originally created?
No, I think that it's more, we create ground leases a lot. So we do, so it's not that we're going out and sourcing ground leases. A lot of times we have a tenant and we create a ground lease. Let me see if we can provide some examples.
Yeah, no, it's really ultimately through the re-tenanting. And, as I mentioned on the call, we've had, a few of the assets that we've converted, but, one in particular, our, single Twin Peaks, we converted that to, 2 ground leases, a Panda and a Jaguars. We've mentioned this before. We had a Miller's we proactively went across in Illinois. That was a ground lease to a Raising Cane's. And, that just allows the re-tenanting and the tenant relationships, allow us to, create the value with having that ground lease. And obviously we all know that the ground lease is terrific because you get the building at the end of the term if that comes back to you.
Okay. And then more kind of with an eye towards, future kind of repositioning of dark boxes or kind of troubled tenants. Who is the buyer for that kind of hops and drops? And I guess why are they buying that at what would be kind of an attractive cap rate?
That's the beauty of this real estate. It's very versatile. It applies to so many groups, from investors to developers to end users. And in this case, it was an end user. And we've got, a great large tract with a versatile building. And that just allows us to achieve these, exceptional returns and recapture rates when we're re-tenanting or we take an asset back. It's such a different type of real estate relative to other real estate that exists out there. And that's how we generate these great returns.
Okay. That's it for me. Thanks very much.
Thanks.
Your next question comes from the line of Rob Stevenson with Huntington. Your line is open. Please go ahead.
Good morning, guys. Pretty much all my questions have been answered. The one I did have was, you talked earlier about the pipeline of acquisitions that you're working on at the moment. Can you talk a little bit about where that pipeline looks in terms of IG tenants? Is it roughly the third that the current portfolio is? Should we be expecting to see IG fall from that level as you do incremental acquisitions over the next few quarters? How should we be thinking about the current pipeline in IG?
Yeah, we have hovered, really since the inception in that sort of 30% IG range. I think we're a little bit higher than that today, almost pushing 34%. And as you look forward and you look through to the pipeline, we do have some IG in there. The upcoming pipeline looks a little lighter, but still in line. And we expect going forward that that 30%-ish IG is going to be sticking with us for the foreseeable future.
Okay. Thanks, guys. Appreciate the time.
You bet.
There are no further questions at this time. I will now turn the call back over to Steve Preston for closing remarks.
Great. Thank you everyone for your time today. We look forward to seeing you at our next conference, and we look forward to delivering strong growth going forward. In good health to all. Thank you.
This concludes today's call. Thank you for attending. You may now disconnect.